Am I buying Netflix stock? The company has crashed by more than 60% from its all-time high. It has also come with several new top series since then, and it's changing its model to include ads, as well as gaming, but is the stock a good long-term investment according to its fundamentals? Stay tuned and find out the most valuable information. As always said with educational purposes and is not meant as financial advice. Let me start with the latest financial results from Netflix and then discuss some of the risks. The information is from late October of 2022. The revenue during this last quarter increased by only 6%, which is quite below the last several years of growth, and during this year it was the first time in Netflix's history where they lost subscribers. They lost 200k subs in the first 3 months of 2022, and during Q2 they lost 1 million more. But the good news is that in Q3 Netflix gained 2.4 million subscribers, which offsets the losses in the beginning of the year. Analysts expected only a 1 million gain in subs, but it is also much lower than Q3 of 2021, when the company gained 4.4 million new customers. A catalyst for Netflix is the fact that most recently, streaming has become the #1 go-to place for TV-like content, surpassing both cable and broadcast. The current market share of streaming is about 35%, while the share of cable has fallen to 34%, and broadcast is sitting at a little more than 20%. A bad catalyst, though, is the ever-increasing competition from other players like Amazon, Disney, HBO, and Apple TV+. The current market dominance is still held by Netflix with about a 25% share, but the trend is evident that most other platforms are gaining in share. For me personally, Disney Plus is the strongest competitor due to their enormous gallery of IP content they can provide. Things such as Lucasfilms, which is the owner of Star Wars, Marvel, and of course, all of the Disney characters is an incredible advantage, which is already built in for Disney. Netflix has quite the pressure to produce new and top quality films and series, which still need to be proven, while as in the eyes of Disney, their model and movies have built-in audiences from the get-go. Also a big issue is that Netflix has one of the most expensive subscriptions, while other companies are constantly pushing for lower pricing. That squeezes the profit margins of Netflix, which are also pushed to lower prices. So from a competitor perspective, I would say that the company has a lack of moat. A moat is a value investing term coined by mostly Warren Buffett, and it states that a company has to have an incredible competitive advantage, which does not allow for new competitors to come into the market and take market share. Well, obviously, this is not the case. Also, companies like Apple and Amazon can afford to play in this space, even if for the next decade they lose money. This is due to their massive other cash cow operating businesses and massive cash reserves. Just for comparison, Disney Plus grew its subscriber base by 32% in Q3 compared to last year, gaining around 35 million new customers in 2022 alone. And the product is about 2.5 years old, while Netflix is more than a decades-old platform. The way Netflix is changing its model now is in two ways. First, starting from November of 2022, they're implementing a new ad-supported subscription model, which will have 30 to 40% lower prices. For example, the current subscription costs are $9.99, while this new service will cost around 6.99 cents, as stated in their press release. The basic ads plan will have 5-minute ads every 1 hour. Whether this will work out or not is still unknown at the moment. Will the customers like this product and will it increase the revenues of Netflix are questions that will be answered only after 1 to 2 years. A big problem for Netflix is the sharing of passwords, which is making them lose a fortune. In their most recent Q3 report, they stated that in 2023 they will roll out a solution to this problem. But again, investors are uncertain if this solution will help the situation. Beyond TV and movies, the company is coming up on the 1-year anniversary of its gaming launch. This will be a multi-year journey for them to learn how to please game players. They now have 35 games on service, all included in each and every Netflix subscription without in-game ads or in-app purchases. And now they're seeing some encouraging signs of gameplay leading to higher retention. Netflix now has 55 more games in development, and what they have seen is when a series or movie is coupled with a game, the gaming segment is exploding. As stated in this article, after the release of the anime spin-off Cyberpunk, game time for the game went up 7-fold just in a month. This drives more time spent on Netflix per user, which is one of the most important metrics. But again, this new idea and model is needed to be tested. Let's now make a fundamental analysis on the company. I start off with the forward PE as it shows the next 12 months of expected earnings. The normal PE, most of the time called trailing PE, could sometimes be misleading as it shows the earnings in the past 12 months. And we as investors invest for the future, not the past. So expectations are that it will be 23.5. This is too high for me personally. Recently, the PE was 15 for Netflix and the price of the company was about 50% lower. At these levels, it looked much more appealing from a valuation standpoint. According to Peter Lynch, one of the great value investors, such a PE needs to be justified with at least a 15 to 20% growth in the revenue or net income, preferably even 25%. As we saw, the latest results show how Netflix is growing with single digits. So from a profitability standpoint, Netflix is a no for me. When analyzing their debt levels, Netflix is a good position. Their long-term debt-to-equity ratio is 0.67, which is below 1 and it's okay. The company also has 6.1 billion in cash and cash equivalents, and it has a current ratio of 1.05, which indicates proper short-term liquidity levels. The two favorite metrics of Warren Buffett in order to evaluate the company's business efficiencies are the ROIC and ROE. The ROIC stands for Return on Invested Capital, and it is 12% for Netflix, while the ROE or Return on Equity is 28.2%. Anything above a 12% return is considered very good. So Netflix passes 2 out of the 4 major criteria. It has good debt management, it has strong business efficiency, but the valuation of the company is a bit too high and the company lacks a strong moat, which increases drastically the competitor risk. So it is not a buy for me personally. Subscribe if you enjoyed and leave a comment down below what other stocks you want me to cover next. Goodbye for now and until next time.